Hi, my name is Yanni, and I want to ask me, how do you analyze a real estate deal? And we'll just use this example to walk you through how do you analyze a real estate deal to make sure your investment is solid. This is from our experience, or exactly how do I approach a property. There are many people who use different ways, but this is just our methodology that we used successfully since we started investing on real estate. So here we have an example, a three-unit building that we sell. At the time, they were selling it for $138,000. So before even contacting the realtor, that there are quick analysis that I'm going to show you now that we do uh, that will help us make a decision whether to pursue this particular property or not. So the first thing that we quickly determine is the gross income of this potential property. So in case of a three-unit building, we know out of those three units, two of them are two-bedroom units and one was one bedroom. And clearly we know the area, and we found out the gross income for this property was about $28,380. Those are actual numbers that were presented to us by the realtor when we asked for it. But even if you don't have this number, if the realtor doesn't give you a number, you can quickly estimate how much the one bedroom can rent or two bedroom can rent in the area that you're buying. And you multiply that by 12 to get the gross income. But in this case, we just asked the realtor to give out the number. We asked them what was the last year's total income, and they provided to us the $28,380. Straightforward. This is step one. You need to find out how much is the gross income of the property. Step two includes you have to calculate what are the expenses. So usually you may not know all the expenses, or the realtor may not disclose to you all the expenses. In such a case, we assume 40 to 45% of the gross income will be expense. This is without even specifically stating what kind of expenses. So you can use this as a general rule of thumb that uh, 40 to 45% of the gross income will be expense. And also, we do ask the realtor to provide us the detailed expense report from last year. And in this particular example, they did provide us the actuals uh, regarding expense related to this property. So the first one was insurance. That's just, it is what it is, whatever number that they provide you, that's what you're going to use. Vacancy, we always assume 5%, but depending on the area that you're looking for, you can assume between 5 to 8% as a vacancy expense. This is not an actual money, but it's just not cash out as out, but it is lost money due to vacancy of the property. So we always minimum we assume 5% in our case for our properties. Utilities. This is something that you get from the realtor. They provide you. Uh, this is how much the owner paid utilities as far as this particular property concerned. So when we talk about utilities, of course, there's electric, there is gas, there's water, there's sewer, there's trash. Most of the time, electric and gas is on the tenants. So you don't count that in your analysis if the tenants are paying their utilities. But if they're not paying it, then definitely you have to consider it. In this example, the water and sewer was utility paid by the landlord, by the previous investor. So that's going to be our expense going forward. So we needed to account it here. But electric and gas was under tenant's uh, name, so we didn't include it on this utility information. So one thing that you have to keep in mind is property management. Always have to assume this. This is just in case if you don't want to deal with operating the property in terms of finding tenants, dealing with the tenants, repairs and maintenance for this property. We can hire a property management company, and they usually ask between 8 to 10%. So that's just an estimated number. The average is about 10%, but it could range between 8 to 10%. Repairs, by default, we assume 10%. Sometimes the realtor can say, hey, there's nothing that you need to worry about repairing whatsoever. Just ignore that part and move forward with the assumption you need 10%, no matter what. Or some of them, realtors, they may say, it's only 5% or 3% is what the repair cost for last year is. In that case, we still go with 10% assumption, uh, just to make sure our investment is solid. So this is just what we use, 10% for repairs. Taxes, this is just by you type the property address on Zillow.com and it will tell you what's the property tax for this for last year. So you use that number. So when you add that up, all the expenses comes out to be $13,017. So step three is when you need to calculate the net operating income or NOI. This is the most crucial, important number to have, and it's calculated. Basically, you take the gross income minus the expenses. This is the net operating income that you have after paying the expenses. It's very important. So in this case, $28,380 minus $13,017. When you subtract that, you would get 15,363. So the NOI is the most important number. In this case, it's about $15,363. Step four includes now you have to decide if you're going to take a loan, which you should, unless you are offering a full cash offer. If you're taking a bank loan, you have to calculate the mortgage. You can use Zillow.com again or Realtor. There are many online apps you can use. In our case, we decided to put down 25% as a down payment, and we took a loan about $103,500, $103,500. $103,500 as a loan, and our mortgage came out to be per year is about $68.58. This is step four. Okay, step five. Then you take the net cash and basically cut that by taking the NOI minus the mortgage. The difference will be your net cash. This is money that is coming to your pocket after paying everything, after paying the mortgage. As you can see, this is something it's coming to your pocket. You can invest. You can invest it or you can spend it on wherever you want. So that's the last step when you analyze this. Okay, now we came to the decision points. There are two things we look for every investment property. One is the cap rate, and two is the cash on cash return. So the cap rate is basically the NOI divided by the price, and that's going to be a percentage. So we always look for 10% or greater for all the investment properties that we own currently. That's what we always look for. and if that meets our criteria, and also we look at the cash on cash return. This is basically the net cash divided by the cash out. The net cash is basically what you find at on step 5. Cash out is the down payment plus closing cost. Uh, uh, Basically, this is how much cash came out of your pocket to secure this investment. Any quick repair at the beginning of the purchase, anything, closing costs, the total cash out of pocket. That's how you get the cash on cash return. Means for the cash that's out, what is the net cash that I'm getting, which is a great, important key factor for us to make decision on a property, and we always make sure we're getting greater than 10% as well. Well, thank you so much. This is a very quick lesson for you to do your analysis. It shouldn't take more than a minute to do that. Once you know how to do it, it's very straightforward, and you can quickly analyze it and make a decision whether to pursue a particular property or not. Thank you so much. Take care.